There was a time when the world believed Japan would surpass the United States and dominate the world. I'm not talking about World War II, I am talking about late 1980s. If you're a big fan of 80s movie, you probably know what I'm talking about.
Hey, we're flexible. Pearl Harbor didn't work out, so we got you with tape decks.
So what was happening in 1980s? And why isn't Japan ruling over the world right now? To answer the question, we have to go back to 1970s. 1970s was not a great period for Americans. America lost war in Vietnam. President Nixon resigned before impeachment. The oil shock proved America was no longer the leader of the global economy, and this change could be felt in 1980s in a harsh way. Japanese goods dominate the American market. Even buildings in great cities were being bought by Japanese companies. Many people believed Japan would be the new superpower, surpassing the United States. So, what happened to the United States? The greatest economic change was abandoning Bretton Woods system. Korean War, Vietnam War, and rising industrial power in Europe reshaped the global economy, and it led the fall of Bretton Woods system. And what's Bretton Woods system? It basically means $35 is 1 ounce of gold. In other words, if you have US dollars, it means United States owe gold to you. This system worked well when Europe was not fully recovered from the World War II. European nations still needed to import large amounts of American products. However, as they recovered from the war, the situation had changed. European nations accumulated US dollar, and this meant US owed gold to these nations. But it turned out that America spent too much dollars. The United States gold reserve was already rapidly declining late 1960s, and there wasn't enough gold to pay. In 1971, President Nixon officially canceled the convertibility of US dollar to gold. Now, US dollar was backed by nothing, and a new economic phenomenon called stagflation happened. Despite a slowing down economy, price of goods were rising fast. American industry had to compete against foreign products, while US dollar was losing its purchasing power. At first, American government believed economic stimulation was more important than controlling the inflation, since it was directly related to unemployment, and unemployed people don't like voting for the ruling party. So, how did American government stimulate its economy? Here's a simple answer. More government spending by power of government debt. US government spent its budget for various subsidies, massive government projects, and social welfare, but this only flooded the market with more money. It only made the inflation much worse. In 1980, the Federal Reserve Bank decided to control the inflation and raise the interest rate up to 20%. Because of the high interest rate, commercial banks stopped borrowing money from central banks to lend money to others. The inflation disappeared gradually, but it also discouraged investment activity while raising government and corporate loan interest rate. It ultimately slowed down the economy, causing massive layoffs. With high Fed interest rate, the interest of US government bond raised up to 15%. For foreign investors and banks, 15% interest rate with virtually no risk was too attractive, and this caused another problem for central banks in other nations. As foreign investors converted their currencies to US dollars, the price of US dollars soared. If it kept becoming expensive, it could encourage others to buy more of it, causing inflation of their own currencies. To prevent this, many central banks in other nations had to raise their interest rate too. This, of course, created the same impact of high interest rate in the American economy. The global economy had entered a recession, and in this period, Japanese products began to dominate the global market. They were known for durability, high quality, and most importantly, cheap price. And remember, this was way before made in China overwhelmed the world, and no other nation's manufacturing industry could compete against Japanese. So, what was the secret of Japan's success? Some argue that Japanese culture was the key for the success. Another thinks Japanese corporate structure provided great strength for Japanese products. However, in this video, we will focus on Japanese government policy. First, Japanese government heavily regulated on importing foreign products to protect their industry. Because of their harsh regulations such as health and safety, foreign products couldn't enter the Japanese market. But Japanese government was not the only one who was doing it, and there was another factor: currency. Japanese government had been controlling their currency value for export, and it allowed Japanese goods to dominate the global market. Normally, if a country has more export than import, it accumulates foreign reserve. As the supply of foreign currency exceeds the demand of it, the currency exchange ratio changes, and the price of exported products in foreign nations naturally goes up. And as they become expensive, it was more likely to be sold less and reduce the amount of export, eventually bringing the trade balance. But in Japan's case, the currency exchange ratio was never really changed, despite of its imbalanced trade. In 1980s, many developed nations were suffered from high interest rates, but Japan's had a much lower interest rate compared to the other nations. There were several reasons behind of it. First, Japanese government saw industrial development was more important than inflation, since economic recession shrank the industrial power. Second, Japanese export always outnumbered import by a large margin. Therefore, even if Japanese banks convert Japanese yen to US dollars, Japan could sustain the loss of foreign reserve. The last reason was Japanese people's lifestyle. In 1980s, Japanese average saving rate was 34.5%, which was one of the highest, if not the highest rate. Instead of spending money, many Japanese preferred to simply deposit money to their bank account. So there was no massive money influx to the market directly. With lower inflation rate than America, the Bank of Japan didn't really have to raise the interest rate. And whenever America lowered their interest rate, Japan also lowered theirs, and it allowed banks to convert Japanese yen to US dollar, keeping the export advantage in the currency. In 1985, United States, Great Britain, West Germany, France, and Japan agreed to end the global recession. And of course, they all knew a month's high interest rate was hurting the global economy. To lower America's interest rate, they needed to stop protecting their industries from other nations and make American dollar cheaper. But they needed a solid target to keep their promises. So, the 5 nations agreed to depreciate US dollar by half, and it was called Plaza Accord. Before Plaza Accord was agreed, a dollar was worth 0.75 British pound, 2.8 Deutschmark, 8.7 French franc, and 237 Japanese yen. A year after Plaza Accord, the price of US dollar was dropped by 9% in British pound, 25% in mark, 21% in franc, and 29% in Japanese yen. In 1988, US dollar became more cheaper, and goods from Great Britain, France, and Japan lost its advantages. As we can see, Japanese yen was the greatest victim of Plaza Accord. For example, in 1985, 500 million Japanese yen used to be 2 million US dollar. But 1988, it was worth 4 million US dollar. Overall, the price of Japanese products doubled in 3 years. In US perspective, the trade balance would remain same, but for Japan, its profit was reduced by half. There was another bad news for Japan. New nations such as Taiwan, Thailand, and especially Korea joined manufacturing competition in global market. A year after Plaza Accord, Japanese GDP growth was reduced from 5.3% to 3.3%. It showed how vulnerable Japanese economy was to sudden changes in global market. Japanese government realized there must be a great change in Japanese economy. First, Japanese economy was heavily relied on foreign market. It needed a bigger domestic market, and for that, it needed a great economic stimulus, such as massive government project. Second, to increase export as it used to be, Japanese yen must be weakened. And lastly, Japanese economy was too focused on manufacturing industry. For these changes, it needed government support and low interest rate to attract investment. But not everything went as planned. First, Japanese government tried to pour money to domestic market through construction boom, and central banks also lowered interest rate to make it easy to borrow money. But the inflation they hoped never happened. They underestimated how frugal Japanese people were. Instead of spending money, Japanese simply put more money on their bank accounts. Furthermore, because of strong yen, foreign investors were converting their currencies to Japanese yen, which made yen more expensive. There was also a problem in Japanese corporate structure. Japanese companies tend to form strong alliances that members of allies form exclusive chain of supplies, But this also prevented companies from making radical changes, so no amount of money could diversify Japanese industry in a short time. But despite of the side effect, the economic stimulus was working thanks to the surplus money from government spending. People witnessed a huge cultural boom in mid-1980s. Japanese animations, new inventions, and video games surprised the world. Companies were having difficult time because there were so many jobs but not enough people. University students had multiple job offers even before graduation. It was also not uncommon that companies went bankrupt because there was not enough people to work. Big companies and banks in Japan also enjoyed buying sprees. American companies, buildings, entertainment industry, and a lot of art pieces were bought by Japanese buyers. Even on screens, people believed Japan would take over the world soon. If you're still having a hard time to understand, here's a historical fact. The total asset price in a single district in Tokyo was more expensive than whole California. There was a rumor that the total asset values in Tokyo was more than the entire United States. There is another historical fact. In 1988, top 5 global companies in total asset values were all Japanese companies. In top 50, 32 of them were Japanese companies, and only 15 of them were Americans. Now there was a real problem. Despite of tremendous government spending and very low interest rate, Japanese yen was still too strong. Even the inflation rate never surpassed the American inflation rate. Then where did the money go? The truth was, Japanese companies and banks were spending money for buying stocks and real estate a lot. In 1985, the interest rate was 5% and there was no significant change in Japanese stock market. But as the interest rate goes down, the market reacted immediately. When the interest rate hit 2.5%, the Nikkei index almost tripled compared to 1985. The same thing was happening in the real estate market. From 1985 to 1989, average Japanese real estate price also skyrocketed. As the prices goes up, more people wanted to buy before it becomes too expensive. And thanks to the cheap interest, banks were more than willing to lend the money for that, taking the building they paid for as collateral. But after 1989, people began to feel something was not right. The construction boom forced people to move out of the city, and they couldn't afford to buy their own houses near the city they used to live. And yet their prices were still going up. The government realized something needed to be done. To solve this problem, the Bank of Japan raised the interest rate, but this was not an easy option. Raising the interest rate will make banks pull money from the market. It could help lowering the price of real estate and stocks, but it could also cause unemployment, shrinking consumption, deflation, strong yen, which has negative influence in export and recession. The Bank of Japan only needed to adjust housing and stock prices, avoiding all the other side effects. There was another problem outside Japan. In 1988, a new international banking regulation called Basel Accord was introduced. As financial market expands internationally, there was a need for international regulation for banks' risk management. The key concept of Basel Accord was simple. Banks must be safe. And to keep banks safe, it gave safety scores, which was called risk weight, for each type of assets. Cash and government bonds were considered as the safest, mortgage was moderately safe, and corporate stocks were the most dangerous. And every bank that wants to trade international financial market had to maintain risk rate above 8% before 1993. It wasn't really a difficult task since banks still had 5 years, but it meant Japanese banks will have some limits in selling mortgages in future. In May 1989, the Bank of Japan began to raise the interest rate to control the bubble in Japanese economy. The interest rate went up to 3.25 from 2.5%, but the stock market and real estate market never went down. In October, the interest rate went up by another 0.5%, but nothing happened. Finally, on Christmas of 1989, the Bank of Japan raised interest rate to 4.25%, and stock market finally showed a reaction. In a single month, the Nikkei index crashed, lost its 25% of total value. However, this was not enough for the real estate. March 1990, Bank of Japan raised interest rate to 5.25%. The Nikkei index lost 33% of its value, and people began to feel the recession already. But the housing price was still rising, 5 months later, Japanese interest rate hit 6%, and the real estate market finally stopped going up. In March 1990, Japanese government announced a new regulation. Now those who want to buy real estate can only borrow up to 70% of value of the real estate. It means the buyer must pay the rest 30% without borrowing money from the bank. This regulation brought panic in market since it was allowed to borrow 2 times of the real estate value. Because of the insane real estate price, this was practically forbidding average middle-class people to buy houses. Even worse, big companies couldn't afford to buy it because of the high interest rate and stock market crash. The bubble was finally collapsing. But the government forgot the banks were lending money to everyone by taking their real estate as collateral. As the real estate price collapsed, many investors who were paying the loans for higher price took a great loss and gave up paying the loans. This let housing price fall even more, and more people gave up paying loans and mortgages. Now the banks were in deep trouble. All they had was real estate assets returned by lenders, and their prices were collapsing. Even worse, because of Basel Accord, they had to reduce the risk-weighted assets by selling mortgages and stocks. When Japanese government thought the real estate price finally went down, they quickly reversed their decisions. They lowered the interest rate to 1.75% in 1994, but Japanese economy was not recovering from the bubble burst. In this period, Japanese GDP increased only 1% per year in average, which was far less than other developed nations. It was the beginning of the lost decade. So what went wrong? Why lowering interest rate didn't cure the recession? The biggest problem was in the banks, because their loss from the real estate market was so huge that they were not in position to lend money. In fact, many banks were supposed to go bankrupt, but the Japanese government subsidized failing banks, and even if they had money to lend the others, many of their loans went to emerging markets such as Korea, Taiwan, or Thailand for higher interest. And they were the greatest competitor against the Japanese manufacturing industry. This was just the beginning of the decline. In 1997 and 1998, Japanese economy faced another crisis. In fact, Japan was not the only victim of the crisis. Thanks for watching, and in future, we'll see what happened during Asian financial crisis. But before that, there is another story in Europe. It's about Britain, European Union, and a guy named Soros.